Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day. In this video, I'm going to walk you through the process of valuing Johnson & Johnson stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Johnson & Johnson was founded in 1886. It develops medical devices, pharmaceuticals, and consumer packaged goods. Its common stock is a component of the Dow Jones Industrial Average. Johnson & Johnson is one of the most valuable companies in the world. Its headquarters are in New Brunswick, New Jersey. The corporation includes 250 subsidiary companies with operations in 60 countries and products sold in over 175 countries. Its brands include numerous household medications and first aid supplies. Among its well-known consumer products are Band-Aid, Tylenol, Johnson's baby products, Neutrogena skincare, and many more. Let's get started with the model. This is a large cap company, 421 billion market cap. They're trading at $160 a share, and they have 2.6 billion shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see the company has lots of free cash flow each year, $17 to $20 billion a year. Net income is the profit and loss on the income statement. It's revenue minus expenses. They had low net income in 2017, which we'll talk about later, but they had lots of net income in the rest of the years. $15 to $17 billion. Revenue is the sales for the company, and their revenue is really high, $75 to $82 billion a year. They also have really good profit margins, 18 to 21%. Net profit margin is net income over revenue. It's how well you convert revenue into profit. So they converted 21% of their revenue into profit in the trailing 12 months, which means 79% went towards expenses. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. That's pretty consistent each year, $51 to $54 billion. Then you have your operating expenses. Then below that is operating income. That's gross profit minus operating expenses. So they have about $20 billion of operating income from their core operational business. Then you have other income and expenses and taxes. So they have $17 billion of net income in the trailing 12 months. The reason they had low net income in 2017 was the US government applied a one-time tax penalty to companies that kept money overseas to avoid paying taxes in the United States. So they paid $16 billion of taxes, even though they had only $18 billion of pre-tax income. This was a one-time thing, so it shouldn't affect their net income in the future. This is the statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So you can see in 2017, they generated $21 billion of operating cash flow with a low net income. Then you have capital expenditures, which are investments in property, plant, and equipment. That's $3 to $4 billion a year. Operating cash flow minus CapEx gives you your free cash flow. And the company has lots of free cash flow left over each year, $18 to $20 billion a year. With free cash flow, the company can pay a dividend, which they do. They can use the free cash flow to pay down debt, which they also do. They can buy back stock, another thing they do. Or they can reinvest back into the company, which of course they do that. So you can see the company repurchased $6 billion of stock in 2017, $6 billion in 2018, and about $7 billion in 2019. So another way to reward investors is to buy back stock. When a company buys back stock, it lessens the shares in the market, which makes your shares more valuable and the stock price goes up. The company issued $10 billion of debt in 2017, but paid off $3 billion. In 2018, they paid off $4 billion and paid off $3 billion. So when you add up 2017, 18, and 19, it looks like they issued as much debt as they paid off. In the trailing 12 months, they issued $11 billion and paid down $3 billion. So in the trailing 12 months, they added $8 billion of debt. The most important part of any business is their operating cash flow, because if you cannot generate positive operating cash flow, you don't have much of a business. And this company generates lots of operating cash flow. In the trailing 12 months, that was $21.6 billion. The way you calculate operating cash flow, you start with net income, that's $17 billion. Then you have to add or subtract the non-cash items on the income statement. That is $7.1 billion depreciation expense. Then they had $275 million asset impairment, so we have to add that back on a statement of cash flows. They had $1 billion in stock-based compensation. When you look at net income, that's called a profit and loss, but that's accounting profit and loss. That's not actual cash. If you want to know how much actual cash the company generated, you need to look at the statement of cash flows. Let's look at a capital structure. $59 billion of equity, $28 billion of debt, but they have $8.4 billion of net debt. So they can pay off a lot of their debt with the cash on their balance sheet. The company's 68% equity, 32% debt. And their WACC is 7.25%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $518 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $464 billion. We divide that by 2.6 billion shares. We get a calculated stock price of 176. They're trading at 160, so they're trading at a 9% discount. It's a buy according to the model. Simply Wall Street values the company at 243, so they're saying it's really undervalued. They're saying it's a strong buy. The stock price overall has gone up the past 5 years. It did take a dip in March when the market crashed, but it came back up past its all-time high. So there's nothing stopping this stock. The company raises its dividend each year. The dividend yield is 2.5%. The payout ratio is 62%. Payout ratio is annual dividend over net income. And they pay out 57% of their free cash flow. That's annual dividend over free cash flow. If you invested $10,000 into this company 10 years ago and reinvested the dividends, you'd have $34,500 today. If you did not reinvest the dividends, you'd have $30,700 today. If you put $10,000 into this company in January 2011, you would have pretty much made money wherever you sold, and the longer you held, the better you would have been. This company has a low beta, 0.7, so the stock moves less than the market. The stock has gone up 10% in the past 52 weeks, worse than the S&P 500, which went up 16%. The 52-week low was 109, the high was 161. And the stock is trading above its 50-day and 200-day moving average, so it seems to be on an uptrend. This is a fairly liquid stock. 7 to 8.5 million shares are traded each day, and all the shares outstanding are on float. 70% of the shares are held by institutions, and has a low short percentage, only 49 basis points. The biggest shareholder is Vanguard at 8.7%, BlackRock 7.4%, then State Street, Capital Research, and Geode Capital. The average PE in the market's 11.9, the median is 14.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. Their PE is 24.8, so a bit worse than the median and average. 24.8 means investors are paying $24.80 for $1 of earnings. Price to sales is stock price over sales per share. They're at 5.2, between the median and average. Price to book is stock price over book value per share. They're at 7.1, a bit worse than the median and average. And the way you calculate book value per share, that's equity over shares outstanding. Equity is assets minus liabilities on the balance sheet. And they have $59 billion of equity, but negative $21.8 billion of tangible equity because they have $81 billion of intangible assets on their balance sheet. A company gets intangible assets through mergers and acquisitions. Interest coverage ratio is EBIT over interest expense. They can easily cover their interest payments. ROE is net income over equity. They have a great ROE, 29%. Current ratio is current assets over current liabilities, a great current ratio, 1.3. And the current assets are $19 billion of cash, $15 billion of receivables, and $9 billion of inventory. And the company is well capitalized. They had $18 billion of free cash flow, working capital of $9 billion. Working capital is current assets minus current liabilities. And they have a dividend payment of $10 billion to pay. The best way to look at ratios to compare them to similar companies, I've done videos on AbbVie, Amgen, AstraZeneca, Biogen, Gilead, GW Pharmaceutical, Horizon, Eli Lilly, Merck, Novartis, and Pfizer, all in the same industry as JNJ. And if JNJ has a number in red, they're worse than the average. If they have a number in green, they're better than the average. So they're a little worse in PE ratio, a little better in price to sales and price to book. They have a good current ratio. They're doing better than average in ROE. The average company is 50% debt. They're only 32%. And they're the biggest company on this list. They're one of the biggest companies in the world, 421 billion market cap. And their dividend payment is a little higher than average. So to summarize, I have them trading at a 9% discount. This company is such a monster with such a strong brand, and they're always coming up with new products and acquiring new businesses, so they're constantly growing. So in the long term, I don't think you could ever go wrong with this stock. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.